I can't believe nobody saw this. I'm going to show you something that's very important, very different than 2018, very different than the previous cycles. We're going to look at, of course, the Federal Reserve. The first thing I want to cover is the Fed pulling out. All right. The second is 2018 repeat. I'll show you the similarities. I'll show you the differences as well. I've got a lot to cover. Let's begin. So the Federal Reserve meeting minutes had come out. It revealed some important information. The mainstream media picked up on a bunch of things, which I'll show you here, because of course it is key to understand the generalities of what's happening. But deep buried within that, I have the actual FOMC minutes, and I'm going to show you a little bit of something that I don't think people have yet to pick up on. This is a quote. With no explicit discussion of a date to begin balance sheet runoff or the idea of a 50 basis point hike in March, the minutes are on the less hawkish side of expectations. But they aren't the last word on anything. And of course, you could see this right now. All the analysts, they're trying to comb through this and figure out what is going on. If you look at what happened in the market, I think it's important to see the way it reacted, and that was quite positively. Okay, the market did go up as a result. At the bottom here, a number of the participants commented that conditions would likely warrant beginning to reduce the size of the balance sheet sometime later this year. Okay, so that's where we're at right now. There's the possibility of hikes coming in, of balance sheet runoff, all of that. But right now, today, nothing. So the market thought, all right, we got some more time. But let's go a step deeper. Let's do this together, okay? From the federalreserve.gov website, remember at this channel, you always get it directly from the source. Other channels out there, you got to demand they do the same. Always make them cite their sources. If you want it, down in the description under the sources. Quote, a few participants noted that asset valuations were elevated across a range of markets and raised the concern that a major realignment of asset prices could contribute to a future downturn. That's one. Very important, on its own. Because what are they saying here? That, yeah, we've had some crazy prices when you look at the markets. And of course, when you see that rise, it always creates problems. Irrational exuberance from Alan Greenspan, right? We go on further. Two more sentences, okay? A couple of these participants judged that prolonged accommodative financial conditions could be contributing to a financial imbalance. You think? Obviously, we've talked about this. The more money they print in, the higher the prices can get. As they start to draw that away, the lower they get. And that brings me to the next point. A couple of other participants cited reasons why elevated asset valuations might prove to be less of a threat to financial stability than in past reversals of asset prices. Translation, if the stocks start to come down, if real estate starts to come down, it isn't a worry for us as the Federal Reserve as it was back during the financial crisis, because people aren't so stretched. So what you should take from that is very simple. The so-called Fed put, the Bernanke put we had, of course, the Yellen put, the Powell put. You've heard this term being used before since the days of Greenspan. What does that mean? If the market gets to a certain level, they're going to print and push it up higher. It's kind of an unwritten rule. But now what we are seeing in the minutes themselves, that we're not as concerned about that. This isn't a statement to the public. This isn't Jerome Powell up there in front of everybody telling them they're going to be okay. This is the FOMC meeting minutes. Now, it's not what goes on behind the scenes, behind closed doors, but it is one level deeper. And to hear that, it gives you a little bit of insight as to what the FOMC is thinking, that they're going to allow asset prices to fall further than they would in the previous cycles before pumping it up yet again. And I do believe that that's what they want to do. They want to own everything, but not before a nice big crash. I'm not saying that's coming now. We don't know when it's going to come. But what it says is that they're willing to take their foot off the gas. Right here, they're just saying about, in particular, they noted the relatively healthy balance sheet positions of households and non-financial firms, the well-capitalized and liquid banking sector, and the fact that the rise in housing prices was not fueled by a large increase in mortgage debt, and so on and so on. Yeah, it can take a shock. So we can pull away and everything's going to be just fine. That's what the Federal Reserve is saying. That's in the meeting minutes. I hope you do appreciate that. We're going to go into this on multi-level today. Americans' credit card balances spiked $52 billion in the last 3 months of 2021. Inflation is partially responsible, raising the cost of food and gas. This is a record speed of increase. Unbelievable, right? You're telling us everything's okay, healthy balance sheets and so on. And then you've got people spending on the credit cards, 17% plus, 17% plus interest rates during this time. Does that sound like they're okay? Probably not. This is crazy. So you get the information out there talking about retail sales. They're fantastic. They're growing. Look at it a step deeper. You got the credit card factor, people using their credit cards at a record pace right now. And then you have this, the adjusted retail and food services sales. That's the green line. It's up. Okay. And over time, this is going back from the 90s to present. Over time, you would expect more money to be spent. Inflation is there, more population, so on. So it goes up. But look at this, the unadjusted retail sales total. It shows you the situation is not good at all. But they can bend it and smooth it and manipulate it using this seasonal adjustment. Look at the difference. We've never seen this difference in between the two. There's going to be fluctuations in the unadjusted. You see that, okay? But there's a huge divide in between the two right now. And you can go to the Federal Reserve website, the Fed website, and see that for yourself, okay? Just if you're interested, always check that out at the Fed website. So looking at this, how magical thinking led America to $30 trillion in debt. This comes out of Forbes, and occasionally you do get some good info out of Forbes, or at least something that I could agree with. And essentially just saying that, they talk about how the spending bills will pay for themselves and so on. And of course, that's not the case. And so it talks about the worry of adding to the debt, how big of a problem it is. And certainly we are feeling that today. Many people don't realize what will happen as the debt expands, but certainly the middle class is going to get hit with the bill, let me tell you. Now we get into the financial aspect of this. The great rotation into stock funds risks a 2018 style collapse. Imagine this. At the same time, you're seeing the stock inflows potentially weakening. Now, right now, money's being thrown into stocks, let me tell you. But according to JP Morgan, that could weaken. We've got record buybacks happening, so the companies intend on pumping a lot of cash in. So we will see how it goes. And just basically saying right here, define the worst January for the S&P 500 since 2009. Investors have sunk $152 billion into equities this year. Crazy, right? Because they're trying to get the same returns that they had last year. At the same time, the bond market really concerning right now. And we'll see what happens if rates continue to rise. Then, of course, it makes the bonds more attractive, but we will see. Okay, there's a good chance in 2022 in terms of equity fund flows, they will look like 2018. It started very strong in continuation of the previous year, but at some point that flow picture will be wilting. So just showing you here that money during this period of time, not even close to what it was in 2017 and of course 2020 and beyond. You've got this insanity that's happening with commodities. I think I have another chart on that as well, but this is lumber. going up over 1,300 right now. Remember, it went from like a historical norm, went up to 1,700 as it was coming down. It was pointing the finger. Oh, see, look, it was the supply chain problems. And now look, lumber's at 450. It's deflation everywhere. Like I've said 100 times before, deflation can absolutely come, but it is not around at this point. It's just not, okay? Home buyers in the US lose hope as costlier loans sap affordability. We are already seeing this. The mortgage rate, this is a 30-year loan, hit more than a 2-year high of 3.69%. That's 20% higher than Christmas. So you could see that jump right now. I don't know if, yeah, this is this one right here. And it depends, where you're getting. This is just the 30-year fixed average, but it depends on where you're getting your debt from. Freddie Mac providing this, who knows? You go to your bank, it could be absolutely could be 4% at this moment. If you're in the United States, depending, on the terms and conditions, there's so many factors here. The point is, it's been rising. It's been rising a lot. At the same time, the rents have been rising too. And the national rent index is up 18% year over year. So it's basically people are getting punished over and over again. Now, we want to see asset prices fall. We want to see a cooling off. We don't want to see things going up like crazy, going down like crazy. These type of things end up, businesses overreact. They start to lay off people. You start to see some crazy stuff. If it was slower and more concentrated and things wouldn't get so out of whack, it would be a lot easier to predict and do business into the future and so on. 2018 case study, equity fund flows subsided amid the market turmoil. That's just showing you more. Again, when we have this pullback from the quantitative tightening, when there's less money being printed into the system and they're actually reducing their balance sheet, the market's not going to like that. It is the number one factor. Remember back during the financial crisis, if you looked at what really pumped up the markets, it wasn't the TARP bailouts. It came later when the Federal Reserve said, we will commit to printing more money. And as soon as that happened, markets head higher pretty quickly thereafter. I showed you this a couple times now. I think this is the third time I showed you. You're looking at the purple line, and that is what? EWZ. That's the Brazil ETF. I showed you this. If anybody took this trade and looked into it after I mentioned it, let me know in the comments below. But this, kudos to you. Fantastic growth over this period. It was oversold on the technical level, and we have watched that increase at the same time. This is BCOM, essentially commodities rising at the same time. Very interesting to see that here. I'm showing you what's happening. Bank of Canada, they're on target, March, raising rates, just like the other central banks around the world. You look at the Bank of Canada, the Fed, they're usually doing the same thing. They've already done their quantitative tightening. In terms of, I should say, be specific on that, the tapering of the purchases, they wanted to get out of that. They're still maintaining the amount of their balance sheet, but then they're going to go and pull out entirely. So we'll see if that is the case. Okay, I'm going to give you all the updates you need to know. So if you want to make sure you get those, hit that thumbs up button. And by the way, I hear from people every single day. Believe it or not, every single day. And they tell me, I'm subscribed to your channel, I have the bell notification on, and I do not hear from you. What's going on? Why is this like this? Why are you not notifying me? I didn't even know you still make videos. You've got to do what you can. You got to come to the channel every single day. I post every single day. Okay, it's like 365 literally, and this has been going 10 years. So if they're not going to notify you because we know, hey, they don't want you to know this information. They don't want you to know what I talked about with the Federal Reserve. Look around. Is it in the mainstream? You tell me. Is the alternative talking about it? Please, we got to share this information. We got to get it out there. All you got to do is hit that thumbs up button. When you do, you're basically notifying, like forcing that algorithm, and hopefully we can sneak through there. I do appreciate that very much. If you haven't seen this video yet, you definitely got to check it out. Click it, and I'll see you there.